Clean energy stocks are well into an established bull market run. It's a sector with serious momentum behind it. When we recently looked into the most popular funds amongst UK investors, a fund containing only clean energy stocks was in at number 3, wildly ahead of other industry-specific funds and even general US S&P 500 funds.
Even if you don't really care about all that green stuff and just want your portfolio to make you some serious flipping moolah, then clean energy is looking more and more each day like it should be part of your portfolio too. There are sound reasons to believe that the momentum behind this sector is a long way from over yet, with many wind and solar energy companies very much still at the initial stages of the technology's potential.
And with Western governments lining up behind clean energy and throwing everything but the kitchen sink at it from their taxpayers' money, you'd be swimming with the tide by allowing your money to tag along for the ride. Should you jump aboard the clean energy bull run? And which stocks have the best outlook? Let's check it out.
Welcome to Unshackled.com, the investment and finance channel and website that says you and your finance is free.
That was Andy and I'm Ben, and if you like what we say, hit the like button and click subscribe. First, we want to give a special shout out to free trading platform Stake, who are sponsoring this video. Stake is FCA regulated, has fractional trading, and there are no FX fees when you trade, across their huge range of around 4,000 US stocks and ETFs, including the clean energy stocks mentioned in this video.
The app has built-in analyst tools, including ratings and price targets. And Stake are giving away a free US stock worth up to $100 to everyone who signs up via our link.
We'll put the link to the offers page in the description below, so be sure to check that out. Now, let's get into the video. The new energy. Investors used to get their energy fix from a cup of Texas tea, but now oil is falling out of favour. The smart money is assumed to be in clean energy, but so few of these companies are self-sufficient. Is it all just good feelings and ideology?
The overtly dominant position of governments in the West is that clean energy is a good thing, and are very pro subsidising it until it can reach an advanced enough stage to survive in the open market. Only Trump's America remained opposed.
Wind and solar power are assumed to provide unlimited cheap energy, but in fact they are very capital intensive. To make much energy, you need to litter the countryside in very expensive tech, compared to gas power stations which already exist and for which the gas burned is very cheap to source. The question of whether cost effectiveness takes another 10 years, 100 years, or never seems to be largely irrelevant. Governments are committed to transitioning away from fossil fuels.
Investing for fundamentals. Don't worry, we're not about to suggest you should invest your money based only on what is popular with world leaders at Davos, although it often does help to go with the flow. We also demand good fundamentals from our investments, but when researching the industry, we were reminded how just so few clean energy stocks have sound fundamentals.
They're mostly either loss-making or are propping up revenue by taking on a ton of debt to buy their assets with. Take a look at the top 14 clean energy stocks by fundamentals floated in America, according to Stockopedia. Of these, 5 are loss-making, a further 3 have too much debt based on normal stock-picking principles. A debt-to-profits ratio over 4 is usually far too high.
3 are listed in the US, but are really based in China or Israel. No offence to China or Israel, we just don't know enough about these parts of the world to invest directly in individual stocks from there. 9 have price-earnings ratios that are either infinitely high because they have no earnings, or are too high to be attractive investments. They are purely speculative.
This leaves 3 companies worth investigating further. And remember, these 14 stocks were a listing of the clean energy companies with the best fundamentals on the market.
Loss-making debt guzzlers. Although clean energy companies are likely to continue to receive subsidies over the next decade or so, we like our assets to be productive under their own steam. You can keep a coma victim alive for years on a life support machine, but remove the machine and they're done for. Our investments need to be able to stand on their own 2 feet.
Those many green stocks which are either loss-making or heavily indebted and yet still valued at billions of dollars are most at risk of being caught out if subsidies were to suddenly dry up. With that in mind, we want to pick stocks with a proven track record. And with clean energy, there is a strong argument to invest at stock level rather than through an ETF. Back in the early 20th century, the invention of the car looked set to change the world, and it did. but there were more loser stocks in the car industry than there were winners.
Using popular iShares Clean Energy ETF, INRG, as an example, the sector average PE ratio is very high at 32, probably because so many of the component stocks don't make any earnings. There are a lot of shaky looking companies in the industry which will be caught up in an ETF.
Top clean energy stocks. Number 1, Renewable Energy Group. In our view, this stock looks the best of the bunch in terms of fundamentals, and I've just added it to my portfolio. This $2.2 billion company has a PE ratio of just 5. It's dirt cheap. In fact, it's the second cheapest US listed clean energy stock. This is a green stock in more sense than one, with the traffic lights on Stockopedia being pretty much green across the board. It qualifies for 6 screens, which is high praise indeed. A decent stock might normally qualify for 1 or 2. This is saying that 6 tried and tested stock picking methodologies would choose this stock over others. For comparison, this is one of just 13 US stocks out of 10,000 that qualify for 6 or more screens.
So what does it do? REG is a producer of biofuels which will mainly be used to power industrial vehicles like lorry fleets. Asking America to replace its entire fleet of lorries with Tesla trucks would likely bankrupt most businesses. However, just switching the fuel of lorries to a compatible diesel made from plants is a significantly cheaper, easier, and therefore more realistic and likely green solution.
Going back to the financials, we can see that revenue, which ultimately drives profits, was climbing strongly every year to 2019, but projections for the next 2 years are lower. This is understood to be coronavirus related, with a current reduction in travel of all kinds lowering the demand for fuel.
It has a good health score, but Stockopedia is throwing up a warning on the potential accuracy of the accounts, telling us we should look into this further. On closer inspection, it's because they have a big chunk of profits that exist on paper only, not yet received as cash. But this is normal practice in the sector, and that money is guaranteed.
It's from REG's main subsidy, a tax credit worth $1.25 billion, which is backdated across a few years, which is not yet being received in cash from the government, but has been recorded in revenue. So, not a problem.
Scooting on down, its liquidity is fantastic, and unlike most of the industry, this green stock has no net debt. Instead, it's sat on a couple of $100 million of net cash.
The downside? There is no dividend. So you'd be buying this stock solely for expected capital growth in an evolving energy landscape.
Number 2, wind energy. In the US, the Democrats would cover the countryside in wind turbines and solar panels if they were in power, with 500 million new solar panels and 60,000 new wind turbines wanted by 2025. If Joe Biden wins in November 2020, then expect this to be the immediate plan. If it's a Trump win, then the plan simply gets delayed by 4 years. But a splurge on wind power is sure to happen sooner or later.
The obvious big boy of the scene is NextEra Energy, a $150 billion Goliath in the wind industry. But its forward-looking PE ratio is 125, which makes it ridiculous as an investment, just shy of being the most expensive stock in America. Also, its net debt is through the roof at $45 billion, around 10 times its expected 2020 profits.
Broadwind, though, is a pretty good dark horse in the race, which produces parts of wind turbines. First, it is a small cap stock at just $75 million, tiny compared to NextEra, and so has loads of room for growth. It hasn't turned a profit recently and was on our list of top 14 green stocks as a loss maker, but on further digging it is expected to start turning a profit from this year. This would give a PE ratio of around 13, not bad at all.
It doesn't pay a dividend, which is normal for a stock this small, that's still very much in growth mode. And its debt is high at $23 million, but if profits hit $7 million by 2021, then this would just be a 3 times debt ratio, acceptable by any standard.
Number 3, silver. Until recently, all silver was good for was sitting in a vault and looking impressively valuable, but now silver has a significant industrial application. Not only is it used heavily in the production of electric cars, it is also essential in the production of photovol in PV cells, the building blocks of solar panels.
As we've just said, when the Democrats are next in power, the plan is to build 500 million new solar panels, and each one of these uses silver. The 2020 election aside, over the next couple of decades we're sure to reach a position from one government or another where solar panels get built in bulk in the deserts and open plains of mid-USA. And when that happens, silver's price will surely skyrocket.
You can invest in physical silver through an ETF, or you can invest in a silver mining stock. The benefits of investing in a commodity producer is that you can get paid dividends, and cash is king. Pan American Silver is a Canadian headquartered stock traded on the Nasdaq, which operates out of silver mines in North and Central America.
The company has strong revenue growth, which hasn't always translated into strong profits, but its profit projections look promising. Essentially though, the share price of this stock tracks more or less to the silver price shown here, but with a dividend thrown in for good measure.
What happened to oil? Oil enthusiasts can take solace that while high PE ratios run riot in the clean energy sector, dirty energy stocks can be snapped up for next to nothing. This is reflected in the current rock bottom oil price and in the ridiculously low share prices of oil stocks. ExxonMobil has a balance sheet of net assets worth $192 billion, but its shares are priced at a market cap of only $144 billion.
Don't underestimate big oil. They have seen the writing on the wall, and Exxon alone invests $1 billion a year into R&D science for new energy technologies. The oil companies that we think of as dirty energy today might be the leading hydrogen or fusion energy producers in 20 years' time. If they don't invent the winning formula, they will buy the company that does.
Question of the day: which energy companies are in your portfolio? Let us know in the comments below. Thanks for watching. On this channel we talk a lot about personal finance, investing and all things money. And if you want to see more great content, please click the subscribe button below.
This is moneyunshackled.com. See you next time.